Hey, thanks for tuning in. In this video, I'm going to update my buy recommendation for Confluent stock. There was a couple of big changes in the company's performance in the latest quarter. I'm going to look at that. I'm also going to look at the company's valuation in terms of the forward price to sales ratio. And I'm going to look at the company's longer term history in terms of cash flow from operations. And I'm finally going to come to the conclusion and answer what I think the stock should be rated at, whether it's a buy, sell, or a hold. So let's get started with the company's third quarter results, the latest update, and then we'll get into the longer term cash flow, and then we'll get into valuation. So let's get into the quarter.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Total revenue came in at 200 million. That was up 32% year over year. Confluent Cloud revenue increased 61% year over year. This segment is the faster growing part of the company's business. Non-GAAP operating profit margin increased by 22 points year over year. The company is making very slow and steady progress on that front. It had its first positive non-GAAP EPS quarter. Now take that with a grain of salt because non-GAAP is not generally accepted accounting principles. That means the company made adjustments in order to say that it achieved positive earnings per share. More important would be if or when it achieves GAAP EPS without adjustments. That would be a more critical milestone. So the big news that came out from Confluent was the decrease in the outlook for the fourth quarter and for the full year 2023. Management said there's two factors that impacted their outlook for the fourth quarter revenue growth of 21 to 22%, which would be a significant deceleration from the third quarter revenue growth of over 30%. Now, two of those factors were number one, two of its large customers had an impact and decreased their spending. One of those two situations was worse. I've highlighted here in the small print. One online gaming company moved workloads back to their own data center, and one of our largest customers ramped slower as they are in the process of being acquired. These two customers account for roughly 50% of the consumption shortfall in the fourth quarter of 2023. So let's take that one at a time. The first one is the more troubling. The online gaming company that moved workloads back to their own data center. This seems more like a long-lasting downside for Confluent because if they move their workloads back to their own data center, they're going to use that probably for the foreseeable future. Whereas the other situation where the larger customer ramped slower as they're in the process of being acquired, that may or may not be longer lasting. After the acquisition, they might resume spending with Confluent or they might switch to another provider. So that could be a concern as well. However, that's more of a maybe or maybe not. Whereas the first one, it's a lot more likely that they're going to stop spending with Confluent altogether. That's a long lasting decrease in spending, not good news at all. And it's long lasting bad news. It's not like a temporary thing. The second factor is macroeconomic pressures. Confluent highlighted that the ongoing conflict in the Middle East, where Israel is a top 10 country for Confluent. And so, of course, you've been hearing about the war in Israel and with Gaza and Hamas, and those factors caused decrease in spending in the region, and that was not good news for Confluent. That might be more of a short-term issue that will likely resume when the conflict is resolved, when or if the conflict is resolved. However, the big thing to take away from this slide is that one online gaming company that moved its workloads back to their own data center, that's a longer term downside. That's not good news for Confluent stock investors. So management restated their goal here, saying that they want to emerge stronger, more aligned with customers, and better positioned to capture their $60 billion total addressable market opportunity. And I pay close attention to total addressable market opportunity. That's an important factor in my investing decisions. Typically, when a company has a larger market opportunity, I'm willing to pay a higher price for that stock because they have a longer runway for growth. Whereas a smaller market opportunity, I'm less willing to pay premium prices because that growth cannot be as long lasting because they'll reach the ceiling, right? They'll hit the cap of how much more they can grow. And to put this $60 billion market opportunity in context, it's relatively small. It's one of the smallest total addressable market opportunities out there. For instance, advertising. The advertising industry is a $900 billion total addressable market. The home improvement industry as well is a $900 billion total addressable market. So a total addressable market of 60 billion is on the lower end of all existing total addressable market opportunities in available worldwide right now. In the third quarter, the company's non-GAAP operating profit margin increased by 22 basis points to negative 5.5%. Non-GAAP net income per share, we talked about earlier, came in at 2 cents. That was up 15 cents year over year. The free cash flow margin of negative 6.5% was up 24 points year over year. That's a good sign. And the company's got $1.9 billion of cash on hand. And given its improvements and narrowing free cash flow losses, this is plenty of cash to get the company where it needs to go, eventually self-sustaining, generating free cash flow, operating the business without needing to go back to investors and raise more capital. In the quarter, the company reached 4,910 customers, which was up 16% year over year. The company added 80 customers from the previous quarter. Customers with over 100,000 in annual spending increased 25% year over year to 1,185, and customers with over 1 million in spending increased 38% to 155. So taken together, if you look at this, the struggles that Confluent is having is with smaller enterprises, smaller businesses, because you can see customers with over 100K grew by 25%, customers with over 1 million grew by 38%, but total customers only increased by 16%. That means there's a significant slowdown in smaller customers, those that are spending less than 100,000 annually with Confluent. And you could take that in a couple of ways. You can say, well, at least they're making good progress with high value customers. Yes, that would be true. But at the same time, they're losing traction with the smaller customers, which there are a lot more of the smaller customers in quantity. So there's a pro and con with this quarterly update in terms of the customer growth. Overall, businesses have been more cautious in terms of their spending, especially in discretionary categories. Anywhere they can possibly pull back spending, they've been pulling back spending because of the uncertainty surrounding the macroeconomic environment. And this is more true with smaller enterprises. So this is common. I'm seeing this with several cloud companies, data companies, anything where there's discretionary spending involved, business to business companies, they're seeing a slowdown from spending from their other business clients. The dollar-based net retention rate is an important metric that I look at with companies that are providing services to other businesses. A percentage over 100 shows me that existing customers are spending more with the company year over year, and that tells me that they're gaining good value from their spending, because otherwise they would decrease their spending instead of increasing their spending. So it's a good sign to me when a company has over 100%, and for Confluent, it came in at just under 130%. That's a good number. That's a good number for a company to achieve. That means companies are spending 30% more this year than they were last year with Confluent, existing customers. So existing customers are increasing their spending with Confluent overall by 30%, and that's a good sign. That means that they're getting good value. That's a good indicator that they will continue spending with Confluent longer term because they're getting good value for their money. Remaining performance obligations increased by 24% to 824 million. The current portion of remaining performance obligations increased by 31%. This is roughly in line with the company's revenue growth of about 30% in the quarter. Remaining performance obligations are contracts that Confluent has signed and has yet to perform those services. So it may be that a company signed a 3-year contract with Confluent for 50 million, but they have yet to consume those services. And so right now it stands as a remaining performance obligation. And as that client consumes that service, it will turn into revenue. It's a good indicator of future revenue. And I typically like to see remaining performance obligations growing faster than revenue, which indicates that the company's revenue growth will accelerate in the future. When remaining performance obligations is coming in below revenue growth, as it did with Confluent in the current quarter, and that continues for several quarters, that could indicate that revenue growth will continue to decelerate, which is a sign that I'm willing to pay a lower price for a company like that because the company's growth is slowing, it's not accelerating, which is, it's fine, but don't expect me to pay a premium valuation for a company that's experiencing this kind of trend. So I mentioned earlier the company decreasing its annual revenue target to 768 to 769 million, which would be up 31% year over year, namely because of significant slowdown in the fourth quarter, where revenue is expected to grow at just 21 to 22%, which would be below the annual 31% growth for the year. Non-GAAP operating margin expected to come in positive in the quarter between 0 and 1%, significantly better than the year-over-year number of negative 9%, and non-GAAP net income per share of 5 pennies, and to come in relatively flat for the year. So progress being made on profitability as well. Longer term, however, the company's cash flow from operations over the trailing 12 months has only recently ticked upward, right? The company was moving in the wrong direction for a long time, where cash flow from operations was negative, and that negative number was getting worse. In the last few quarters, however, they've made it where this number is still negative at negative 143 million, but at least it's moving in the right direction. At least it's improving, and they stopped the decreases. That's a really good sign if you're a Confluent stock investor. And finally, the stock is trading at a forward price to sales of 6.3, the lowest it has been according to this metric going back to the July of 2021. And I would say that for me, this is too expensive for the company with its current characteristics, with the small total addressable market, with still generating negative cash flow from operations, with experiencing decelerating revenue growth. All of those factors leads me to be uninterested in paying this kind of premium valuation for Confluent stock. So I came into the quarter with Confluent stock being rated as a hold, and I'm keeping it there. I'm keeping it rated as a hold. I'm not upgrading it. I know the stock price is down significantly since announcing those earnings results. I don't think that's a buying opportunity. I think investors are better off just waiting to see where the company goes, if there's a better price point to get in, if the company makes better progress in its cash flow from operations, in accelerating revenue growth, before I can recommend this stock as a buy. But before I let you go, if you gained any value from this video, please subscribe to the channel. It really helps me make more videos just like this one. Thank you so much for watching, and if you're already subscribed, thank you so much. I truly appreciate your viewership.